central banks have said, don't worry about our balance sheet, don't worry about whether we make profits or losses. We exist only to deliver our mandates, primarily our inflation mandate. Now, what I point out is that by expanding their balance sheet, they've made it harder to deliver the inflation mandate.
Welcome back to Breakout from Breaking Views, brought to you by PGIM. I'm Peter Fallassen, the global editor of Breaking Views, and I'm joined this week again by Edward Chancellor. Eddie, good to have you back on.
Nice to see you again.
So this week, Eddie, you've taken a look at the opaque but important question of central bank balance sheets. Most of us are probably dimly aware that central bank balance sheets have expanded a lot since the financial crisis of 2008. But why has that happened, and why does it matter?
Let's start with how much they've expanded their balance sheets. The average developed economy central bank has a balance sheet that is now around 70% of GDP, which is, I think, five to six times the historic average and nearly twice the average of the size of balance sheet peak at the end of the Second World War. So we're clearly in very new territory. And the question is, and we know why they did it. They did it with quantitative easing in order to ease the problems of the Great Recession. The question of whether the balance sheet matters, now there's a view, we live in a world of fiat currencies, and the view is the central banks, it doesn't matter, they don't have depositors, you can't have a run on the bank, they create their own liabilities in the form of money, and so they can't technically become insolvent. So what's to matter? And I approach this from a historical perspective, and I cite a book by this American economic historian Jacob Sowell called The Reckoning, in which he argues that the rise and fall of nations and empires has been charted by their adherence to strict accounting standards, and the nations fall when they don't apply those accounting standards. And then I mentioned another.
And is that what's happening now with central banks? I mean, you talk about some of these central banks that some of them are slipping into the red on a sort of accounting basis. Are they fudging the numbers, or what's going on there?
In the 19th century, when we had sort of gold standard, the banks kept very, very strict, rather unleveraged balance sheets. Now, the central banks around the world apply their own different rules. They operate with large amounts of leverage. Whether they report losses or not depends on their different accounting standards. But for instance, the central banks don't report losses on bonds that they bought for their monetary account, which will not be held to maturity. In conventional banking terms, you would have to report the losses on those. Now, the Treasury has, the Federal Reserve has a nice little twist, which is that every loss is then reported as a reserve asset. So in fact, the more losses it makes, the more reserve assets it grows. So under those conditions, a central bank can't go bust. The Bank of England has put all its quantitative easing securities purchase into a special purpose vehicle. So I say the central banks really have the accounting of Enron.
I see. So okay, so that's so bad accounting or question of accounting is one problem. The other problem that you talk about is slightly different, which is just that this expansion of balance sheets is storing up future problems. Is that right?
Well, so there's a new paper by Neil Ferguson of the Hoover Institute in Stanford, and what this paper finds is that central bank balance sheet expansions over the past 400 years have in the short term been associated with economic recovery, high asset prices, and the end of deflation, exactly what we saw after 2008. But what the researchers find is that if you fast forward 10 to 15 years, that after very large central bank balance sheet interventions, you get a higher likelihood of a financial crisis. And this paper is framed in terms of central bank doves and central bank hawks. And as I say in the piece, the central bank doves have been ruling the central bank roost since 2008, but now it looks as if the hawks may have the best of the argument.
And the hawks would sort of say, well, it's time to be more prudent and maybe pull back on some of this stimulus. But you could also argue that in doing so, you create problems in the broader financial system.
So there's another point I make towards the end of the piece, which is that central banks have said, don't worry about our balance sheet, don't worry about whether we make profits or losses. We exist only to deliver our mandates, primarily our inflation mandate. Now, what I point out is that by expanding their balance sheet, they've made it harder to deliver the inflation mandate, partly because they pay interest on reserves, which are a form of short-term government debt. And that means that when they jack up interest rates, the cost to the taxpayer immediately rises. The other thing is that if the banks choose to sell the securities they bought to withdraw liquidity, they then actually will be forced to realize losses. And central banks with large losses, regardless of what you're told, have less credibility in fighting inflation. The history of Latin American central banks, of Peru in the 1980s, of Venezuela in the 1980s, with their weakened central banks and their incapacity to fight inflation, is something that perhaps the modern central bankers have thought too little about.
Okay. Central bank balance sheets. Time to pay attention. Eddie, fascinating as always. Thank you very much for your time, and we'll see you again soon.